Well, good day, traders. Chris Weston here, Head of Research at Pepperstone. So once again, as you can see from the background behind me, we're looking very much at the gold market. We're looking at a 360-degree holistic view, whether you're looking at technicals, fundamentals. We're trying to get a greater probability assessment of how gold may trade. We're going to have a look at the correlations. What makes gold tick? I think for me that's very important, because when we're trying to understand the variance, or what drives gold's variance, understanding the correlation can be very beneficial to know what to look out for as well. But it's been a tough trade for gold this week. Yeah, we're seeing gold up a little bit in dollar terms over the last 5 days, which is really, really positive for gold bulls out there. The fact that we're actually up, 0.7% in US dollar terms when the dollar has been, you can have a look at what's happening with the yen, but the dollar has been such a strong performer this week. Have you have a look at the chart of the economic surprise index of the US relative to Europe, and that surprise index will go up as data is beating expectations. We can see that the US economic surprise index has been moving up on a relative basis to Europe. So the data in the US has been consistently beating, and you can see the correlation that has with the euro dollar. So as the US data has been beating, European data has been worsening, so too has we've seen some downside in euro dollar. So it's really been this idea that the US dollar has been the standout performer. So the fact that gold over the week is up 70 basis points is testament to how strong gold's been, and the bulls will take heart from that. But will that continue going forward? One thing we have seen is good buying in gold versus against the Aussie dollar. The Aussie dollar has been pretty weak this week, but we're looking for signs that potentially a small reversal in the Aussie that looks a little bit oversold. We'd be personally looking to sell bounces in the Aussie dollar, but certainly let's see what happens with the gold price there. Have a look at the chart of gold priced in euros. You can really see this breaking out of this triangle. It looks like it wants to go higher. If the euro, which as I talked about there, has been so weak, doesn't reverse, it continues through the 109 handle, then gold price in euro terms looks technically quite interesting. It needs a bit of work to do to really break out of this consolidation triangle pattern at the moment, but if that does move up, I'd be going with that and really looking at gold in euro terms. But yeah, so I think when you're looking at gold, it's not just about the currency aspect, not about the price itself, but actually have a look at the currency aspect as well. Gold in US dollar terms, that we're still sort of consolidating in this sort of 15.95, 15.50 range, and again that needs to be respected. In terms of drivers for the week ahead, there's not really too much on the economic front to really focus on. I will say, as we go for the rest of this week, we're still going to look at CPI numbers in the US tonight. We've still got to have a look at what's happening in retail sales towards the back end of the week. That market is expecting 30 basis points, both in terms of the advance read, but also the control group, which feeds directly into the GDP number. Next week, I think we continue to watch what's happening with the coronavirus, and I think what we've been seeing from equities has been that people have seen a sort of a deterioration in the intensity, I suppose. The recovery rates are improving, and I think equity markets continue to grind higher in the sense that people are not looking so much at what's happening in coronavirus, they're looking more at what's happening in the bond market and real yields, and we'll talk about sentiment in a moment. But I think what we will look at is the liquidity argument. I think that's going to be interesting for gold, but also have a look at China as we go through the week. They will come out with adjustments, in my opinion, to their prime 1 and 5 year prime rate. We're likely to see the 1 year prime rate being taken down by 10 basis points or so, the 5 year by 5, and that may influence gold. That may take a little bit of may influence the downside in the gold price there as well. Now have a look at what's driving gold. I love this correlation matrix. It gives me some really good insights to what's happening there. We're looking at the 20-day rolling correlation between these independent variables and the gold price. So we're using a bit of statistical analysis to understand what gold's making gold tick. As you can see from the 20-day correlation, we looked at what the movement was, or the correlation was, the 20-day correlation last week on the 5th of February. And you can see here in the conditional formatting, when it's red, effectively, that red sort of shaded area shows that correlation is 0.075 or below, green 0.75 or above. That's a positive or negative correlation. What we can see now, if we look at the difference now on the 12th of February, is that 2-year treasuries, the 20-day rolling correlation stands at negative 0.76. So it's a pretty strong inverse correlation between 2-year treasury yields and gold. So if we're seeing 2-year yields going lower, we see gold price going higher. It's got an inverse relationship. 76% of the variance effectively can be explained by that rolling correlation. But what's making it tick a little bit more? Well, you've got the 10-year real yields are still the one for me there, 0.78. negative 0.78. And if you have a look at the chart on the next slide, you can see here the moves that we're seeing between 10-year real yields and gold price. I have inverted or flipped that real yield, so effectively what you can see, or the gold price effectively. So what you're seeing is that relationship much more strongly. So again, if you come back to that correlation chart, you can see that if real yields are moving down, you are going to be seeing gold prices going up and vice versa. Why is that? Well, gold doesn't have any yield. So when fund managers are looking at that deterioration in inflation adjusted real yields in the bond market, gold becomes just that little bit more attractive because it has no yield. That's yield in itself in a kind of perverse way, if you so to speak. So you can see there that if bond markets are going to find buyers and yields are going to go down, we're going to see that gold price moving up a little bit there. On the other hand, if we do see, as we go through the new week, bond markets selling off and we do see yields moving up a little bit higher, which is a bit of a big if, but if we do see that happening, then I expect gold prices in US dollar terms to come down to the bottom of that range, sort of into the 1550 range. That is what's making it tick at the moment. On the positive side though, have a look, you can see the VIX is having a bit of a short-term impact, 81% or 0.81%. So if that volatility index does spike back up for whatever reason, you are going to see gold prices moving higher. If you see that implied volatility index of the S&P, the VIX index going lower, you know what it does tell me with that rolling correlation is that gold prices is going to go probably lower in that situation as well. And we've got dollar yen as well. If you watch what's happening in dollar yen, we've got an inverse correlation there as well. So, you know, if dollar yen's going down, we're going to have we're going to have basically a situation with gold prices going up. And, you know, it's all kind of one big interlinked trade. You know, bond yields do mix up with what's happening in dollar yen. The pool of negative yielding debt globally is also there as well. So, you know, we have seen a bit of a deterioration in some of those correlations, but we are still there. We're still very much focused on what's happened in the bond market. If real yields are going down, you're going to see gold prices going up and vice versa. We have a look at the R2 correlation on the right, but for me that rolling correlation still exists. Now let's have a look at sentiment and the backdrop by which gold is looking at. I've had a look at this sort of multi-asset chart, which you can see here from the Bloomberg chart. I've had a look at the S&P. The S&P in the red line is at all-time highs at the moment. Probably not great for gold, but that's obviously a reflection of what's happening in liquidity dynamics. Central banks continue to still be very, very aggressive there. But also, I think, you know, if you're looking at equities, one of the reasons why we've seen the bond market, the equity market so high is because we are seeing credit spreads starting to roll over again. If you have a look at triple B credit spreads, which are the lowest form of investment grade credit, against the risk-free rate, which is US Treasury yields, those numbers are coming down. So it shows that people are taking risk on again in the credit markets. Equity always looks at credit. So those investment grade credit spreads are narrowing relative to risk-free rates. The equity market saying that's great. We like to see that. We also like to see what's happening in the bond market as well. Now, for people who haven't been to university and studied applied finance, it's really important that bond yields move lower for equity prices. We look at the future cash flows of a business, we discount those future cash flows to the present value. It gives you a net present value. Effectively, if that discounting mechanism by which we're discounting those cash flows is falling, and we could perhaps use the 10-year US Treasury or perhaps a risk-free rate, much more shorter duration. But in this case, let's use the real yield. Let's use the 5-year real yield, which you can see that kind of pinky purpley line there. That's been falling away. So what effectively, as that real yield moves lower, it makes those cash flows of the S&P much more attractive. You can also see the CRB Rind Index, which is the orange line there. That's been rolling over. That's not good. That's probably good for bonds. I suppose that's probably good for gold prices in itself. But these are the industrial commodity index that we look at very closely. So this is disinflationary, probably quite good for gold in that situation. So a bit of a mixed picture there. But equities all-time highs. It's a function of what's happening in credit spreads, volatility falling away, and also what's happening there. So probably not the greatest backdrop for gold appreciation. We do want to see equity prices, roll over a little bit. You want to see that implied volatility pick up, but you also want to see when the bond market continue to find buyers. That's the perfect breeding ground for gold in there. Now let's have a look at risk reversals. Let's have a look at the options market. What's it telling us about gold at the moment? Well, if I have a look at the bottom pane, you can see effectively 1 month risk reversals. This looks at the skew of call to put volatility, 1 month 25 delta call to put volatility, implied volatility, and as you can see now, there is a positive skew here, so 1.6 vol difference. So effectively 1 month implied volatility in call options for gold are trading 1.6 volatilities higher than puts. Now that's come back down to the mean. That blue line you can see there is the mean of the 5-year average effectively. So markets are quite neutral in terms of where prices are going. If they generally thought we were going to see this explosive move to the upside, you'd be seeing call volatility significantly higher, pretty much like we saw at the beginning of the year. You can see that trading around 4 volatilities difference. So that showed you that the call volatility for 1 month implied volatility for gold was 4 volatilities higher than put volatility. That was showing you that there's extremities in terms of sentiment. People were saying that there was going to be much greater moves, and that's generally the time when you want to be fading gold, and on vice versa, if we saw its 2 standard deviations down towards 0, where that put volatility and call volatility was similar. At the moment it's come back down to much more neutral levels, and that's kind of reflected what we're seeing in the underlying market, where gold prices are sort of moving sideways. The top pane there I've looked at 1 month implied volatility minus that of 1 year volatility. So we're looking at short-term volatility in gold relative to longer term. And generally when you think there's going to be an explosive move in gold, you'll see short-term vols moving up more aggressively than longer-term vols. Not really happening at the moment. So again, if we're looking at options, we're quite neutral at the moment. Market's kind of missing a catalyst. Maybe that comes from something political as we go into the Super Tuesday on the 3rd of March. But in terms of what we're seeing in price, yeah, we're seeing that 15.95, 15.50, but the options market's very neutral at the moment. If I really wanted to see an explosive move, I'll be expecting to see short-term vols moving up more aggressively. It's not happening. Risk reversals, that skew of call to put volatility is come back down to a much more neutral stance as well. Well, if we have a look at positioning as part of our risk assessment as well, you can see in the top pane here, which looks at the managed money from the Commitment of Traders report, which of course is compiled every Tuesday and was sent to us. We get to see that every Saturday for us here in Australia, or Friday night in the US. And you can see that we're currently sitting long 42,000 net long contracts, which is certainly not at extremities by anymore. I think that kind of fits in nicely with what we've been seeing in the optionality, that futures traders here are very much holding this kind of very nuanced position. It could go either way. There's no real conviction there. You can see that long contracts and short contracts have been gradually building together. There's no real real telling situation from managed money in terms of gold positioning. We're net long, but only very small. So I wouldn't read too much into that. There's not a lot, but again, it tells you that the gold market is missing something. We're going to need to see a much more protracted move down in real yields to really incentivize that gold buying. That VIX needs to move up, and we're probably likely to see dollar yen having to move significantly lower if we're going to see gold moving down there as well. Have a look at ETF holdings. This is a chart that I put out last week. Got a bit of a reaction from clients. They're very much infused by what's happening there. This gold holdings in ETF funds up a touch from last week, takes it to a new record high. You can see that from the white lines. These are gold holdings in ETF funds. Another way of looking at it in terms of positioning. Doesn't mean you're going short gold. Absolutely not, in my opinion. You're looking at other factors in there. Watch price. But what we are looking at this week is a situation where we continue to watch what happens in the bond market. We continue to watch what happens in volatility. If that vol subsides, you'd probably like to see gold price under a little bit of pressure. Guess what we saw from the volatility numbers there. And you're ultimately looking at gold. What currency do we want to choose there? The dollar's been the currency to shy away from. You really want to go long gold in euro terms or Aussie dollar terms. The question is, can that momentum in the dollar be sustained? It's looking a little bit overbought. Perhaps looking at gold in Aussie dollar terms or euro terms is another trade there. So something to watch as we go through the new week. Not a really lot to focus on in terms of data. We are watching obviously what happens in China and watching happens in risk sentiment. But gold at the moment fairly neutral in that positioning.